Hey, it's time for a stock market bubble update. We have the S&P 500 this past week with an incredible rebound, the best rebound that we've seen since the November election when the market went bonkers then. You had the S&P 500 this week up 4.6%, you had the Nasdaq up 6%, and you had the Russell that led the way up 7.8%. Huge week. Now here's the thing about really good weeks in the stock market. It causes people to get very, very aggressive, especially the week that follows because they had time to digest it over the weekend. This is what you want to remember about the stock market. It's not about one day, it's not about 1 week or about 1 month. It's really about consistently managing the risk and making good quality trade setups. So on a week like this week where the market just really had an abnormal week of returns, you don't necessarily have to get all of those returns. You got to remember too that the stock market, it is a journey. You have over 220 trading sessions every year. You don't have to be spectacular on every one of them. What you want to be is consistent and consistently growing your portfolio. The market goes up 6% 1 week and drops 6% the next week. You don't want to ride those turns. You don't want to ride that emotional wave or roller coaster. What you want to be doing is consistently increasing those profits day after day, week after week. Yes, you're going to have down days, you're going to have down weeks. But overall, you got to remember, the stock market, it's more than just 1 day or 1 week. So if you weren't able to keep up with the market this week, that's okay. Don't be too hard on yourself. Now, why was the stock market rallying so well? There was talks about the stimulus checks of $1,400 coming out in the weeks ahead. However, it's more than just the stimmy checks. It was your meme stonks that were going down big time this week. The meme stonks were getting plastered. GME alone, Gamestop, the Gamestop stock, it was down over 85% from the highs of last week. And yeah, it's starting to look like it's dead in the water. Should you go buy GME here? No. Look, the other thing too about the Wall Street bets crowd and the people who are buying these, they're very emotionally invested. They either want to stick it to the man or they want to get rich quick. Regardless of what the narrative is, you got to follow the charts. And when you're following the charts, you can't get caught up in the moral victories or some grandiose populist message that you're buying these stocks because of. Instead, you want to follow the charts, manage the risk. Do that and the profits will take care of themselves. And you'll stay in this game far longer than you ever expected. But I'll give you credit for this. You guys really stuck it to them, made them quiver in their boots. You guys did a good job, man, and props to you. So because the meme stonks are crashing, that's got your stock market rallying because there's less fear of any kind of capitulation with the hedge funds. But watch out, those stimmy checks will be coming out here in a few weeks to a couple months, depending on when Congress passes that next round. And that $1,400 is going to also be going back into the stock market for a lot of people. So you may get another round of these meme stonks going back up, but I don't see it happening right now. And it doesn't necessarily have to be GME or AMC that it happens with next. It could be something else. But whether you think these guys are right or wrong in their quest to push stocks like GameStop higher or AMC or BlackBerry, you can't make trading stocks personal. You just need to follow the market and follow the direction that it's giving you. Don't get caught up in the emotional adventure of trading stocks that it is so easy to do. So the S&P 500, it's up 5 days in a row. The Nasdaq's up 4 out of the last 5. The Russell's up 5 days in a row. Can it keep going higher day after day after day? Yeah, I see it happen, where it goes 9 or 10 days up in a row. That's very possible. It's not normal, but it is possible. And every other week for the past couple of months, we've seen the stock market close at all-time highs. Now, what's happening because of the sharp V bounce that we saw last week following the late January sell-off, the bounce was so steep that there's not a lot of good quality trade setups right now. So what do you want to make sure if you can't find good quality trade setups? And there is still some quality trade setups, you just got to look for them. You got to make sure you're not forcing trades. You can't put stop losses where they don't belong. They need to be below key support level. And if you can't do that, you got to pass on the trade, no matter how good you think the trade setup is. And before I get into the charts, I want to tell you about my YouTube membership page. It's really awesome. There's a lot of good content to help you each and every day in the stock market beyond just these videos. What you're going to get is multiple updates throughout the week on the S&P 500, the Nasdaq, and the Russell. On top of that, you're going to get all of my watch lists that are updated multiple times each week and the daily setups, as well as some of the most intriguing charts that I come across each and every day. And if you're a big fan of the FANG stocks, you get the Facebook, Apple, Amazon, Netflix, Google, Microsoft, and Tesla updated for you each and every week. So check that out down below, click the join button, and sign up. Now check out the SPY chart here. There's some serious resistance. It goes all the way back to the March sell-off. It's tested it 5 times. Each and every time it tests it, it results in a sell-off of some kind. Those sell-offs have gotten a little bit less crazy in terms of the depth of the sell-off, but you want to make sure that you're cognizant of it, because guess what? After Friday's close, we're testing that resistance once again. And so that's going to be in play in the week ahead. What you may not see if it doesn't break out and it doesn't sell off, it's just going to ride slowly up underneath that rising trend line. We've seen that many, many times, especially since November, where instead of just having an absolute meltdown because it can't break through the resistance, it just gradually rises right underneath. And that can create some good gains and opportunities too, but it means you got to be a little bit more patient with the market and temper those expectations. Now, could price actually break through this resistance? Absolutely it could. You know why? check out this resistance going all the way back to like 2012. We tested this multiple times over the last 10 years about, and every time there was some steep sell-offs. Well, we tested it again this year. I was very pessimistic that we would actually be able to break through. In fact, I thought there was a good chance we were going to sell off that. Okay, this rally off the March lows, it's going to burn out right at this resistance level, just like every other rally has done in the past. Guess what? And this is what's always so crazy about the market. Market will do things that you never expect it to do. And it did it here. Instead of selling off, or at least just not being able to break through it, it rallied right through it and it hasn't looked back. It pushed right through it and it has showed zero signs of pulling back so far. And so while this resistance level that's now support underneath may get tested again from the upside in the near future, the point being is that you got to change when the market changes. And so when resistance breaks, you got to acknowledge that and go forward with the new narrative that the market's providing you with. Now, speaking of the weekly chart on SPY, let's go ahead and dig into this here. And I've highlighted this in other videos, but it's still worth pointing out and to provide you with an update. And that's the bearish wedge that is forming on SPY. It's very steep. It goes all the way back to the March lows as well. But you can see price is being contained so far inside of this bearish wedge. So it has to make up its mind whether or not it's going to break out above it, which is much more difficult to do, or it's going to break down below it. But either way, whether it breaks out or below it, you need to be able to adjust to what the market does. Now check out the hourly chart because it's really overbought. And you have this nice rising channel going all the way back to November. And right now, price action is seeing its head bump against this resistance level. So I've showed you on the hourly, the daily, and on the weekly chart, a lot of different resistance levels. There's definitely some obstacles ahead for price action. Now we've seen over the past year how price action can blow right through those, and sometimes it'll do it in the form of a gap higher on the daily chart. But what you want to do is be cognizant of these levels and to realize, hey, maybe I should pull back a little bit. Maybe I don't take as many long positions going forward. Maybe I don't go into margin. Probably shouldn't go into margin at all. But anyway, be careful when you see these kinds of barriers overhead because it could indeed result in a heavy sell-off. And if it doesn't, then you just adjust your trading plan accordingly. Now, let's highlight the hourly chart of the Nasdaq 100, QQQ. Still the same rising channel that we've been in for a couple of months now, but here's the difference. There is still some room to run to the upside. So that's good for like your technology stocks, your discretionary stocks. There's a good chance that we see a good push higher still in the Nasdaq before it runs into any kind of serious resistance. And you can also see that on the daily chart as well. Same channel, and you got a good support at the 20-day moving average. Now, it's not clean support. It's not support that immediately when it tested, it bounces right back up. No, it kind of hovers around it. It'll go down below it a little bit. It'll go back above it. Maybe it'll go back down it again, but then it eventually rallies off of it. It doesn't have any significant break, but it does break it a little bit. So if you see a break in the 20-day moving average go forward, know that it doesn't necessarily mean it's the end of the game here. In fact, it may just be a good opportunity to reload on some long positions that you might have gotten out of recently. But your FANG stocks are on fire. Google led the way. It's up over 14% this past week alone. All your FANG stocks finished higher. Now, IWM is freaking bonkers. I mean, this thing has no quit in it. I mean, it was pretty much dead money August, September, and October, and then it just went crazy in November. Still the same rising channel in place. I even mentioned last week, hey, of all the indices right now that are probably setting up to be the most shortable, it would be the Russell Index. However, I also put a caveat on that saying, look, I wouldn't go shorting that right now. You need to see a little bit more of a break in the market. You're not getting that yet. Yes, the sell-off from the previous week was pretty good, pretty significant, but it wasn't enough to get short in the market. I never got short on anything. So this continues to be the strongest of the three indices. It was up 7.8%, which is pretty much your small caps, versus the S&P 500, which was up 4.6%. So it almost doubles what the S&P 500 was able to do. So here's the thing. Make sure that you understand we are in a stock bubble, okay? Stonk bubble, maybe that's what we'll call it one day, a stonk bubble. But we are in a bubble, but that doesn't mean that you just all of a sudden stop trading, short the market, go into margin, and hope that it crashes at your convenience. No, that's not what we're saying. That's not what I'm saying, at least. What's good is to be cognizant of that, to continue to manage risk, and to not get lackadaisical and think, oh, the market will go up forever, I have nothing to worry about. Because there will come a day and time where the market does correct itself, and you want to be getting out of the stocks rather than getting into stocks at that time. Good quality setups right now are hard to come by. They're still out there, I still find them, but when there's not as many good quality trade setups, maybe your frequency of trading should go down a little bit. You shouldn't be trying to force trades on the market that's not there. Because when you search out good quality trade setups with a good entry, a good stop loss, it's going to set you up for a good exit as well. When you start chasing stocks that are up 50, 60, 70% or up 200%, your exit's going to be horrible from those stocks. You just can't do it. There's too much emotion. There's too much overextension for the stock to really be able to give yourself a good exit from that trade. So make sure you're setting yourself out to find those good quality trade setups rather than ones that you're just FOMOing your capital on. If you like this video, I'd encourage you to like it. That helps me out a lot. And also subscribe. That even helps me out more. It does world of wonder to be able to provide you this best market analysis out there on YouTube. I think it's the best. I mean, it's probably the best. I mean, I spend over 40 hours a week just looking at these charts that I'm showing you here today. That's all I do. So make sure to subscribe, make sure to like, and I'll keep giving you guys this great content each and every week. And tell me down in the bottom, what was your best trades of the week? We had 5 straight days of gains. Let me know down in the comments below what was your best trade of the week. And how are you handling the meme sell-off? I want to hear all about that below. Thank you guys. God bless.